All right, welcome everyone. Welcome to the Hurley Investments Market View commentary for the 30th of October, last one for this month. It'll be pretty interesting. I guess the short answer is all we're going to be discussing today is pretty common knowledge, and there's not much that's going to go on this week until Wednesday at noon. So if we take a quick look at our economic reports, as I just blew right through it, I'm making you all sick. Wednesday, anyone know what we have? FOMC meeting, Federal Open Market Committee meeting, which means our markets will probably after today just go sideways or give it all back as we wait to see if we're going to get a rate hike. And this is the make or break. Today's stock market movement. Anyone know? What was today's stock market movement? What made us go that way? What made us move higher? Anyone want to take a guess? What made our stock market move higher today? Someone throw something out there. Stuart, I know that you do it. Stuart said bonds, which actually I guess there could be a couple things. Did the bond rate, did the 10-year come down below? Let me take a quick check. Oh, 10 years, 5 years up, still up. It is below 5, but it was up today. Deep breath in anticipation of rate hike, possibly, Lee. Interest won't go up now. We don't know that. So it's kind of interesting. I actually thought today's market was nothing more than a technical oversold bounce. And all I'm getting that from is just taking a quick look at the S&P. And it looks like to me, if I go ahead and I put it on right here up at the top, it just looks like we just ever so slightly went into the oversold. And so we had a technical bounce higher. Very rarely, if ever, do we stay oversold for long. That's what moneymakers are supposed to fix this, right? Supposed to put more money into it. Doesn't mean, like at the end of last month, we can't bounce off it 2 or 3 times and go from 43.50 all the way down to 42.16. I told you look out for the 4100. I also said look out for that 40.50-ish range. Boy, we came pretty close to that 4100. I hit it right here recently, right? Pretty darn close to calling the bottom by 3 points, but we have a lot still going on that we don't know about. So I think today's move was nothing more than a technical bounce. Question. why did we not make as much money as the S&P 500 today? So we've come off of 2 weeks, and we've actually come off of 3 months, beating the monthly return on the S&P, which is down, what, 4.82% in September, 2.25% in August. In October, we're probably going to be down about 4%. Why did we not make not as much money as the S&P today? There's a specific reason. Anyone know? And Russ, I might expect you to know. Stuart, I might expect you to know. Lee, you might know. Bill, you should know. Abraham, you should know. Why do we make not as much money as the S&P today? We aren't trading the S&P 500. That is correct. That could be a reason, so that is correct. The Fed, I'm a professional ignorant. No, why did Hurley Investments, why did your account specifically not make as much money as the S&P did today? There is a specific reason. Rich, you might know this one too. Bad investments. Bill, you're killing me. There we go. Abraham. Protection. Perfect. William. Nice to see you, William. Actually, we just stuck at it. Protection. Protection is in place, which means we make more on the way down than the stock market loses, but we also make less on the way up, which is a little funny because the question was asked to me, you know, Kevin, I'm only up, I think we're at 0.78 and the market finished at 0.20. So we missed by 0.42. And he's like, we're not beating the market today. And my comment very politely was, and let's see who's here. And Mary, maybe you just close your ears. My comment was like, no shit. We've got protection on. The reason why we could beat the S&P last week by over 2%, and the reason why we could beat September by over 2% was because we have protection in place. And with all due respect, if I'm not off by 0.5% or more on any one given day without having an explanation, then I'm not really worrying about it. I'm just not. The reason why we did not beat the stock market today was because we had protection in place. We thought about taking some protection off. We thought about letting a couple things run, Meta, Bank of America. Banks actually looked really good today. We did have a couple things that were down today, but when it came down to it, when you have a 1% movement just after that first hour, to a certain degree, we missed it. We just missed it. We're not going to catch tops of tops. We're not going to catch bottoms of bottoms. We just missed it. So instead of chasing the market, we watched the New York lunch hour, which for us, well, is between 12:30 to 1:30 New York time. And the market came back down to like 0.52. And we're like, okay, we get it. It might not hold its gains today. But there was no technical or fundamental indicator that told us to make a change. We are staying protected until Wednesday afternoon. And we're just going to see what happens. Now, out of the group here, if the Fed is going to raise rates, should put it this way, raise rates this year, it is on this meeting. Anyone know why I could be so perfect in saying that? Why am I so sure that if they're going to raise rates, it's going to be on this meeting? If the Fed's going to raise rates, why would it be on this meeting? Fed Christmas gift? No. I like that though. Why would it be on this meeting? And not in December? There is a specific reason. Politicized, expected, last preferred January. Those are all information that is relatively correct. But there's something I think even more important than that. Don't want to create problems retail. That's a good guess. How about, and I'm 99.9% sure, but usually when you have the meeting with the summary of economic projections, you don't have a press conference. And I've not known the Fed to raise rates without having a press conference to explain why they're doing what they're doing. And I'm 99.9% sure the reason why we would not have a rate hike in December is because it's not a press conference, go through stuff. They've already got that taken up with a summary of economic projections for the next year, which leaves it till November. And if it's not November, it most likely will be in January. The big picture, really interesting. Why would the Fed cut rates soon? It won't unless we have a geopolitical crisis brewing in the Middle East and Treasury yields are moving higher. Yes, it's happening. We have a House of Speaker that lacks a speaker. Well, that's been taken care of, so that's off the table. Weekly job claims at their lower level, 198,000. We've actually bounced higher than that. That's somewhat off the table. We have a leading economic index that registered negative readings for the last 18 months. Well, that still is on the table. It's kind of funny, and the GDP thought the last quarter is going to be a 5.4 5.4 real GDP growth for the third quarter? It wasn't. It was only what, 4.9? Let me go back and see what it came in at. It came in at, yeah, 4.9. So it was not 5.4. So really, that's kind of off the table. And we have a market cap weighted S&P 500 that is up 10.3% for the year, and an equal weighted S&P that is actually down 2.8% for the year. Way to go, the big seven, right? The big seven has skewed our typical S&P 500. So the reason why it's going to be at this meeting, because they have a press conference without end of the year future predictions. And those are future economic predictions. They spend their time, no press conference. It's they spend that press conference going over the future economic predictions for the following year. All right, so with that said and that in place, what it all means, Fed Chair Powell and his colleagues have been adamant about their mission to get inflation back to 2% on a sustainable basis. Fed Chair Powell said that the world counts on the Fed to deliver low and stable inflation. They are going to proceed carefully, but with all due respect, if they don't raise in November, we have a bounce towards the end of the year. If they do raise in November, killed the Christmas rally, and we're going to have to wait till January for economic news on the interest rates. Now, kind of ridiculous. I wish I could remember who it was. So I'm just going to say someone important. Said we have a 4,875 end of year target for the S&P 500, or a 17% increase going into the end of the year. And let's find out who said that. 17% increase on the S&P 500. Was it Reuters? Reuters poll S&P index to end up 17% at 44.96. When was this though? Was this today? Nope. Boy, I gotta find out who said that, because it came across CNBC this morning and I just about fell over and choked on myself. I gotta find who said that. It was somewhat ridiculous. But I disagreed with it. Again, a lot of things were said Can't remember who it was, but the short answer is I just don't see it. Talk about, yeah, I like this one. Someone just put in here, joke, Kathy Woods. That would be something she would say. But no, whoever came up with the, hey, we're looking at a 70% increase towards the end of the year, it just isn't going to happen. Fact of the matter is, if we get a 1/4 point interest rate, we're toast. If not, we will have a, was it Tom Lee? Maybe, I can't remember who said it, but someone important, I don't know, predicted that we'd end up towards the 4,800 range, which was a 70% increase from where we closed on Friday. And it just, there's no catalyst in our markets to move us that high right now. So we're staying pat. We're keeping our protection on because we have our interest rate hikes. Yes, it saved us last week. It saved us in September, October in general. So yes, if we're not beating the S&P on a single day, we know you don't need to call and tell us. We're doing this for protecting for the Fed rate hike this coming Wednesday. And we probably are not going to see cuts until the second half, if not the beginning of 2025. It might have been the Wharton professor, Stuart. That's who was on this morning. But I didn't remember him saying that it was up to 4,800. I thought it was, he was commenting on that prediction. Okay, earnings dates. This week, we have Apple. We have Square. We have Under Armour. We have Eli Lilly. No, Under Armour is now the 8th. They changed theirs. Under Armour is now the 8th. So this week we have Apple, actually Pfizer tomorrow, CVS on Wednesday, Thursday, Eli Lilly, Apple, Square. Quite a bit is still reporting. We basically have the banks out of the way. But again, for this week, ADP employment on Wednesday, ISM manufacturing on Wednesday, FOMC meeting will probably be pretty flat till 2 o'clock Eastern Standard Time on Wednesday till we find what the Fed's going to do. Initial claims and factory orders on Thursday, average work week with non-farm payrolls on Friday. It's just going to be an economic report end of the week. And again, all that really matters to start off is the Fed meeting. If they hold pat, we're probably good for the end of the year. We don't have to worry about interest rate hikes till January. And we could get a bounce off of that alone, in which case we'll take some protection off and we'll see if things don't run towards the end of the year. Looking at our markets, not surprising, bearish, but we are bouncing off oversold. If we look at the S&P, same thing, bearish, but bouncing off oversold. And if we take a look at the NASDAQ, bearish, but bouncing off oversold. Reason why we probably won't go much higher, we have a lid at 42.41, the 200-day. There are sell orders stacked up, and they're continuing to be stacked up right there at that line. Another reason why I wouldn't expect a 17% return towards the end of the year, but people can make wild predictions, and sometimes a blind squirrel finds an acorn out in the woods. All right, here we go. I don't know where the S&P is going to end up for November. We are finishing our third down month in a row. Not quite as bad as September, but most likely we'll be down 4% plus. I'm going to say November will be a slightly positive month, but I have nothing to base that on until I hear the Fed meeting on Wednesday. So that's just a pie in the sky dream. Earnings, McDonald's helped us go higher. Tomorrow, British Petroleum, AMD. CHK is an energy company, Chesapeake Oil, maybe. Pfizer on Tuesday, Yum China. Wednesday, Eli Lilly, Humana, Garmin, Kraft Heinz Company, Yum, Airbnb, DoorDash, Electronic Arts. Vacation is what? Marriott. Nu Skin, PayPal, Qualcomm. Wednesday is an interesting day because you have the Roku. That'll be interesting to see how that ends up. Thursday, gold. So you got Barrick Gold, LNG, natural gas there, Duke Energy, Shake Shack, Starbucks, Wendy's, DraftKings, Remax, Eli Lilly, Apple, and Square. After the market Thursday, something to pay attention to. Economic reports already went over. Fed meetings is what's kind of sitting there. I do like, and I had this one, that Jamie Dimon rips the central banks for being 100% dead wrong on economic forecasts. I think I mentioned it last week. Wasn't sure if I put it in, so I made sure I had this for you guys to read through. We'll make it homes affordable again for millions of Americans. Very interesting, and I kind of want to go through this because this is something that's rather, it's poignant, right? Mortgage rates reached a 23-year high. The median price in 2020 for a home was $49,000. Now it's $107,000, and Redfin puts it at $114,627. So homes are not affordable, at least starter homes, right? It's just tough. 8%. In fact, I even like the numbers. The median family is already $9,000 short in August of income needed to buy the medium existing home, the association says. And the recent surge in rates have moved another 5 million U.S. families below the qualification standard for a $400,000 loan, according to the John Burns Real Estate Consulting. At 3% mortgage rates, 50 million households will get a loan that size. Now it's down to 22 million. And it's getting worse, right? So what needs to change to make homes affordable? If home prices are stable, rates need to fall to 3.55 in order to be back to a historical average. If prices grow by 5%, rates need to fall to 3.16. If the price stays the same but income increases 5%, rates only need to fall to 3.95. If a mortgage rate that stays around 8% means the median home prices need to fall 35% to $265,000. If rates stay at 8%, the prices at current levels, income needs to increase by 63%. And all I'm going to say is, obviously, if the auto striker, the auto unions couldn't get their income by 63%, ours isn't going to happen either. I would suggest that you read through this article, because the next crisis will be the home builders. It'll be homes. It'll be the fact that if you have a home over $1 million, you probably can't find a seller for it. If you have a home over that $2 million mark, you have 0.38% of the population, or 0.38% of the people that can buy a home that could afford your home. And that will be a problem. Our next, again, crash, or our next housing market issue is going to be the fact that homes just aren't moving, and that has a trickle down effect in the economy from home builders to home suppliers. You might see a Home Depot or a Lowe's do a little bit better because people want to be fixing up what they do have. But this is a very interesting article. And the fact of the matter, nowhere on the future are the changes going to happen that'll make homes affordable again. So please read through this article. I think you'll find it very interesting. I disagree with this one, but I still put it in here. U.S. oil is back, and ExxonMobil's $60 billion deal isn't even the biggest signal. Exxon and Chevron were buying up oil fields, shale oil fields. Just pay attention to some of this. If you do trade in the oil, pretty important for you. And then Big Pharma's blockbuster obesity drug battle is just getting started. It's headed for $100 billion in sales. This is going to affect Eli Lilly, Novo Nordisk, Pfizer, Amgen, and probably, is it Merck is the fifth one? I'm not a big fan of pharmaceuticals, but again, something pretty important to kind of put on your radar where you might see us move into some more Pfizer. And then I finished the article, the average net worth of Americans broken down by age, see how you compare. It's just a chart, kind of interesting. In all honesty, if you do have an average net worth with your home over $1.5 million between that 55 to 64 range, you're doing pretty good. In fact, you're on the higher end. So just things to keep into effect. But the problem is average net worth is a component of cash investments, retirement accounts, property, jewelry, art, collectibles. Fact of the matter is you cannot probably sell your property right now. If it's over that $1 million range, you're going to have a problem in having your property sold. Just something to put into to help you guys remember. Pretty interesting article. The U.S. consumer is walking towards a cliff. Strategist warns. And I thought this one was rather interesting because I agreed. I didn't have any data, and quite honestly, the data here was not that good either. But the short answer is someone believes that, and this is Jeff Cox, someone believes that we're going through our savings. We are starting to peak again on our credit card, but we always do that prior to Christmas. In fact, you're going to see credit card use shoot through the roof here for November and December. And Jeff Cox basically just is saying, hey, we're in for a struggle coming into the future. And I agree with him. I just don't agree with some of the numbers that he's trying to use here. And it really comes down to consumer spending, obviously, is 80% of the United States GDP. In 2008, I watched people buy new iPhones for their kids for Christmas, even though they were going to lose their home in the 2008 crisis. So it's like, well, I'm not sure much will stop the U.S. consumer. With that said, what questions do you guys have that I can answer for you? What questions? And yes, so actually, William, so William asked a question earlier and I missed it. Thank you for reminding me. Are we going to stay protected through the FOMC rate meeting? Right now, the answer is yes. If I was to look at futures, not that they're a good predictor of tomorrow, but I would probably say they're going to be down. Futures right now are down. The Dow is down 0.07. The S&P is down 0.20. The NASDAQ is down 0.28. Not a a big indicator of the futures tomorrow, but what's some of the news that's coming out that makes me think futures are down? Or why would I say tomorrow will probably be a down day, and why I want to keep protection on? Well, Israel is not agreeing to a ceasefire. We just had a pretty big update today. And with that said, you usually have a sell-off the following day. We have the Fed Open Market Committee that starts tomorrow, so that'll get talked a little bit more. You had Tesla drop 5% at one point in time on battery issues. Again, one of those big 7 that has a knee-jerk reaction to the market. So yes, right now my plan is to stay protected through the Wednesday meeting, and we'll make our adjustments and our assessments the last 2 hours that the market's open on Wednesday. Are there any other questions? If not, guys, I appreciate you being here. William, nice to see you. In fact, I think we just noticed you were kind of gone for a month or so there. Glad to have you back. Lee as well. Lee, glad we got your computer going. Glad to have you back. All right, guys. Hey, look forward to seeing you next Monday. Have a wonderful Halloween as kids are coming to your door. I say you just throw candy at them if they don't have a trick for you. But you guys have a great evening. I look forward to seeing you next week. And I'll work on making sure Dave gets this posted so he can go through some of the notes later tonight or early tomorrow morning. I definitely do want you to go through a couple of these articles. As you read through them, I think you'll find them very, very interesting and important. All right, good night, everyone. I'll see you next Monday. Talk to you later. Bye-bye.